Thank you very much. I think maybe climate change actuary, but actually climate change activist as well. So within the financial sector, I can happily be an activist.
Sorry, yes, indeed. That's me messing up my words there, but activist being absolutely central to that. Thank you, Mike.
But we both. And I think we kind of have some slides, which I think the kind of people who are running this. So what I just wanted to do, I'm just sort of trying to pick up some of the themes maybe from the last panel. There's a great regulatory focus, and the wonderful Mark Manning told you what he was trying to do. But I think I can build on Seb's point from a moment ago. Citizens, savers, whether they're through RFAs, whether they're through pension schemes, whether it's each of us individually, we actually see risks through the lens of the SDGs. We want sort of good water, we want climate stuff sorted, we want education. And I think one way of bringing together the world, which I have it on the right-hand side, which is alpha and beta and capital pricing model and tracking error and all the good stuff the investors do. That's a risk perspective, but it's rather incomplete. So I'm just sort of offering a way of thinking about risk in the way that we think about it on a day-to-day basis. And I'm rather hoping we get some questions, because I may well not speak for the full time. But what's happening ever so slowly is that the risks on the left-hand side, which as humans we care about, it's sort of invading the world of the day job. Number 13's bubbled up. I talk about climate risk bubbling out of the ESG cauldron, and leading asset owners, so leading pension funds, leading insurers, leading providers of investment products. We get to climate first because we understand that there's more we know what to do. So that slide is just to sort of a takeaway to help you think about risk and maybe bring together the risk which we live to day in our jobs with the risk that we sort of have, you know, going home, crossing the road, that sort of stuff. The second slide, I'll just do this very quickly now because I'm rather hoping we're going to get some questions and we'll see how that goes. I was sort of brought, well, I actually wasn't brought, I was brought up an actuary. We didn't really do economics. But, you know, we live in a world of alpha and beta, but in fact, one way of thinking about this is now a big conversation about systemic risk. And if you ever want to spend a few minutes, there's a wonderful organization, very small, called TIIP, which must be the Investment Integration Project. And they do work looking at how systemic issues, we go back to climate, are sort of getting involved in investment. And it could be a pitch for a future session. They have actually produced some excellent work on how purchasers of investment manager product can evaluate the investment manager on dealing with systemic solutions. And I've actually got a deck which I've used at one event, which actually helps asset owners, and I wasn't thinking about IFAs, but why not, evaluate investment managers on how they're dealing with systemic solutions. So that's that one. Next slide, please. This is very institutionally oriented, but what is happening is the following. So just think of a big pension fund. This is what they're doing. We think about strategic asset allocation, and we think about all the ownership stuff, which goes down to proper engagement. But what the leading pension funds and other asset owners doing around the world, and in a way, and maybe what your individual clients are doing, they're just thinking about investment from a sort of strategic risk management point of view. So my apologies for nicking something from the institutional world, but it might trigger a few thoughts with you. That once an asset owner, and personally I'm an asset owner with my little DC pension pot, starts to think about how I'm going to allocate my assets, I go down one side with strategic asset allocation and down another side with how the votes are being exercised and how those who have my capital are engaging with companies. And what is beginning to happen, and there's, if there's a sort of helpful question on COP26, I could sort of respond appropriately and even bend the answer to the question, is a lot of engagement by principally asset owners, but sometimes investment managers, with policy, picking up Amanda's point. So although it's a long way from the world of IFAs, there is a global architecture being built. I think on GFANZ at one point in one of the sessions, the Glasgow Financial Alliance to Net Zero. So there is a global architecture getting really esoteric. One plan is the OECD, the Paris-based organization that was formed to stop fighting each other after World War II. No, Julia, I'm not that old. Was formed then. There is a move to get the financial architecture rejigged, tackle some of these issues, and again we go with climate. And I think there is one last fourth slide, and then I'd rather hope there's some questions, or Julia can provoke me with something. So there is a discussion beginning about public and private risk sharing. I'm just going to ask the question: if you're an investor or an economist, you know, how do you explain that Boohoo was in sustainable funds? How do you explain the risk around Grenfell Tower and the fact that 4 years on people have got flats they can't sell? There are conversations about in the UK about a sort of bigger thing than Poolray. Poolray, you may know, is the way that there's a terrorist insurance organization that was formed after the Bishopsgate bomb in 1992 or 3, I think. So there are ways of thinking about risk sharing. If I'm provoking economists, I say the risk-free rates, the bank rates we see, is only risk-free to financial economists and central bankers, because in fact, the risk-free rate doesn't really look at the risks that society is facing. And if you really want something, I'm afraid it's a bit of a plug, but earlier this year, I wrote a little piece called Government and its Chief Risk Officer's Role and Assessment. That actuaries bit. So I'm going to stop there, and we've got a few minutes. And Julie, I'd love to take a question or thought or comment from you or anybody who's still around.
Thank you, Mike. That was great. So yes, indeed, we don't have loads of questions. So please do put questions in the chat box. Mike can talk on a very wide range of subjects, can I say? But I did ask Mike, as Mike does focus on risk, to start looking at the parallels also, or we can start talking this now. If you're an IFA and you've understood what you're saying about risk and that everything is changing and this needs integrating everything, how would you start them communicating with their clients? And then we've got a question through from someone as well saying, you know, how does a client then communicate with the fund manager? You may have ideas, some of those things. So how do we explain this to the man?
Well, I think this is going to be a bit of a plug for what you do. And I saw a question which has just disappeared. So I'm trying to remember what it was.
Was it in the question box?
Yes, it was. It's disappeared. Well, let me. Oh, it was about derivatives, and it was from Jill, who I met at your last in-person event 2 years ago. So Jill's question was about derivatives. Fundamentally, the economic exposures of a derivative are simply what they represent. So any question you ask about a global equity portfolio, which in some sense you might mirror through a derivative, the question about a derivative is simply a question about the underlying. So if you're asking a question about, you know, futures, you're actually just asking a question about what's in the indices. So that's my answer to that one. And if Jill's got a follow-up, we can do that. Aviva, the launch of an ESG reporting tool, that sounds very interesting. I don't know anything about it, but what I do know is that Aviva, and since we've mentioned Aviva, we'll mention Legal in General, are working with a little fintech firm called Tumelo. And the idea behind Tumelo is that the citizen can engage through the system and begin to express a view on certain societal issues, which then become resolutions at corporate AGMs, EGMs. So a reporting tool sounds very interesting, but I think joining up, there are really only 4 players in the world. There are us as citizen savers, there are asset owners, there are investment managers who invest in this company, and the rest of us are advisors, help us to sort of move that capital. So I think the current politics getting in the way. Yes. So a question from Jan, and one of the things, if you happen to read that little note I wrote, I describe politics as risk management writ large. So politics frames the risk under which we operate. That's what it is. We might get to carbon pricing as one way on climate of linking societal risk with finance, but essentially they do, because the current version of capitalism lets a few too many risks get away. So if we think of what Biden is doing in the States, and obviously a significant change compared to the previous administration, Biden has actually said that the value that Labour gets from working, the risks to climate and decarbonising, they're probably going to do it more through green electricity, carbon pricing at the moment. So I like risks to be at the centre of this, because I sort of understand risk a bit. So the risks to us as people, and we elect people to sort of make rules and laws and change the rules of the game. So I guess my follow-up before hopefully we get another question would be that the notion of free markets is a nonsense. So markets are free to the extent that the risk framing allows them to be free. And what we've done is we've allowed a lot of risk to be delegated by governments through companies to capital markets. Capital markets were not designed to price some of the risks that we think are important. So I think the short answer to Jan's question is yes.
And I think a lot of the issues around this generally, and this is a common one, the concerns about the fact that both politicians and senior business people very often have economics backgrounds, and they're looking at things like they believe there's such a thing as externalities, which those of us that have read widely around this subject. So there's not really such a thing as an externality, there's the planet, which we're busy getting through. So the whole thought process in terms of the system change that needs to happen for people to start to bring that in, whether it's through carbon pricing or other mechanisms, I think is absolutely crucial. And I'm hoping this is giving you time also to read. Sorry, go on.
Bless you. I have. So I've read Anonymous Attendee 458. Do I suggest the SDGs are the future lens through which clients will want to announce their portfolios? I think the answer is yes, because actually in institutional space, that is already happening. I've talked a little bit about strategic risk management. And then the second half, would you imagine that the overlap of listed equities could be relatively limited? Up to a point. I referred earlier to TIIP, the Investment Integration Project. They help us think about this. So I do recommend, just hit their website, spend 10 minutes looking around. But basically, if we use the SDGs, not necessarily as a sort of product tick box thing, but as a way of thinking about risk. After climate, we probably get to pick your favorites. It could be inequality, which is either low pay or high pay. It could be water. The issues. And actually, I am guessing, because IFAs know a lot more about this than me, different clients will have different interests. And I think that will drive, can I say it, Julia, the way you begin to frame the product stuff, because all of a sudden it's no longer alpha, beta, totally divorced from the real world. We're dealing with real world issues that real world savers care about. Now, Roger's asked a question about Boohoo. Well, Boohoo is interesting because any IFA should be asking the question, if one of their clients' savings investments was invested in a fund holding Boohoo and the fund was flagged as sustainable, but you rapidly get to the fact that government and regulators of labour practices were insufficiently tough around risk management. So some societal things happened that we didn't sort of like. Now Boohoo are adjusting, but I think Boohoo is a great example of poor societal risk management. And we have to ask ourselves the question, did investment drive Boohoo to the point that we were uncomfortable? I'll flip that back. And then I think we're sort of heading towards 5 o'clock.
We are heading towards 5 o'clock. And I guess I'll come in with just one comment on the Boohoo bit, that, when I'm thinking about this, a lot of the time I'm thinking of poor women working for lousy subcontractors who may have little English, they're ill placed to do anything for themselves, and if the shareholders don't speak up for them, who's going to? And I know that view isn't always recognised in our industry, but Mike, I suspect that you probably think about the individual that's affected also, but and there's obviously big picture issues that we painted around it, but coming back to what Amma was saying earlier as well, it comes down to individual people. What can they really do? And if you're an employee in a company like that, probably you want someone jumping in, speaking on your behalf and saying this all needs tidying up. I
think there's a limit to what investors can do, because going back to going back to Amanda's point, if the drivers of incented behavior are that this happens, you've got to go right up into this macro stewardship space and make sure there is risk management, because it is not always obvious that the investors will speak up enough. But maybe we'll do that. I'm going to shut up. It's 5 o'clock.
Yep, I'm going to close now. So thank you very much, Mike.